Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Have you ever felt, just completely swamped by all the financial news, the advice, just everything that's out there?
Oh, constantly.
Right. One day it's all soaring highs. The next it's warnings of total doom.
It's a real roller coaster.
And it's so easy to get swept up in that noise, isn't it?
Yeah.
Chasing trends, wondering, how do you even tell what's real insight versus just hype? You want to be informed, make smart long-term choices. But honestly, where do you even start? Is there a shortcut? Or maybe just some timeless principles?
Well, that feeling you're describing, that sense of being overwhelmed by the frenzy, that's exactly what Benjamin Graham spent his life fighting against.
As Dean of Wall Street, right?
That's the one. And his book, The Intelligent Investor, well, Warren Buffett called it by far the best book about investing ever written. Can't get a much better endorsement than that.
Wow. No kidding.
What makes Graham stand out, though, wasn't just theory. His wisdom, his foresight, it was all forged over decades right there on Wall Street. He saw every kind of scam and fraud, as he put it.
He saw it all firsthand.
Absolutely. And his focus wasn't just on, fancy techniques. It was really about investment principles and investors' attitudes.
Yeah.
Mindset.
Okay, so that's our mission for this deep dive then.
Exactly.
We're going to dig into Graham's work, pull out the most important bits, maybe some surprising facts too.
Oh, there are definitely some surprising facts about Graham himself.
And share that timeless wisdom. The goal is to help you cut through today's noise, just like he did back then, to help you make deliberate, consistent, well-informed decisions, regardless of whatever Mr. Market is up to.
Let's do it. #tag the architect of intelligent investing, Benjamin Graham's enduring wisdom.
Okay, let's start with Graham the man. We know him as the finance guy, the father of value investing.
Right.
But what's amazing is how wide his interests were, way beyond Wall Street. You're saying his background is pretty fascinating.
It really is. It paints a picture of just how his mind worked. Get this. He was only 23, right? Still super young. And he publishes an article on calculus in the American Mathematical Monthly, no less, about how to teach it better. And that was just the start. He patented 2 different handheld calculators. Innovative stuff.
Wow, okay. Pre-digital age calculators.
Exactly. Think about the foresight. Then he wrote 2 whole books on stabilizing global currencies, plus tons of articles on law, tax, unemployment.
So really diverse, serious stuff.
Definitely. But then in his spare time, he writes a Broadway play.
A play.
Yeah, and he taught himself Spanish just so he could translate this specific Uruguayan novel. And he read, constantly, in French, ancient Greek, Latin.
Okay, so not just smart. This guy was a genuine polymath. A scholar.
Totally. And that kind of wide-ranging curiosity, that rigorous approach, you have to think it shaped how he saw the financial market.
Right. It's not just numbers then. It's about understanding the whole system. Human behavior, maybe?
Exactly that. He didn't just see balance sheets. He saw a complex system driven by people. And people are emotional. They follow fads. Sometimes they're just plain irrational. His broad knowledge gave him this holistic view. He was, above all, wise, which is pretty rare, especially in finance.
And he definitely saw his share of that irrationality firsthand. Decades on Wall Street.
Oh, absolutely.
He must have seen it all. Insider trading, worthless stocks being hyped up,
Dirty accounting tricks.
companies ripping off their own investors, like a front row seat to every market cycle, boom and bust.
He really did. Lived through the Depression, saw countless market manias, people losing their minds thinking they were geniuses just because a few stocks went up for a bit.
Temporarily,
keyword. And the sad part, seeing ordinary folks wiped out listening to so-called experts promising quick riches.
Ugh. That still happens.
It does. And those experiences just cemented his belief in fundamental principles, which led him to lay out these 4 cornerstones for intelligent investing. Real bedrock stuff.
Okay, let's get into those. 4 cornerstones. The first one you said is maybe the most fundamental. Investing versus speculating.
Absolutely critical. It's the first thing he tackles. He was really clear. You can't invest without trading sometimes, but you absolutely can trade without ever really investing.
Okay, so what's the difference for him?
If your only reason for buying is the price went up or everyone else is doing it, that's speculating. Simple as that.
Herd behavior.
Right. Investing, for Graham, needs thorough research. Deliberate, consistent decisions based on understanding the value. A stock isn't just a ticker symbol flashing on your screen.
It's a piece of a business.
Exactly, an ownership interest in a real business with a fundamental value that exists independent of its daily price swings. The investor focuses there on the business, not the noise.
That distinction feels incredibly important, especially now with everything moving so fast.
It really is the foundation.
Which leads right into a second principle. This character he invented, Mr. Market.
Ah, yes. Classic Graham.
So Mr. Market is this mythical business partner. Shows up every day, totally manic depressive.
Ha, that's a good description.
He's either euphoric, buy, it's going to the moon, or he's in total despair, sell everything, it's worthless.
Precisely. And the intelligent investor sees Mr. Market for what he is. It's an opportunity, not a guide, not someone whose advice you take seriously. You, the investor, you're the realist. You sell to Mr. Market when he's being overly optimistic and offering you a crazy high price.
And you buy from him?
When he's pessimistic, miserable, and offering you a bargain, you use his irrationality. You don't let it control you. His mood swings are a tool for you, not marching orders.
Okay, so don't get caught up in his drama. Use it.
That's the essence of it.
And this focus on principles, on attitude. That's his third cornerstone.
It is. Graham was very upfront about his book's purpose. He literally wrote, "Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes."
So it's not a how-to guide for picking stocks.
Not at all. No hot tips. It's a blueprint for the right mindset. Understanding the why behind investing. Sticking to timeless guidelines. It's about how you think and how you behave, much more than what specific stock to buy today.
Which brings us perfectly to number 4.
Yeah.
Building habits. Discipline.
Yes.
So ultimately, this deep dive isn't just about knowing this stuff intellectually. It's about actually building the habits, getting that discipline that you need to succeed long term. It's about controlling yourself, maybe even more than controlling your portfolio, especially when Mr. Market comes knocking, yelling about the sky falling.
Controlling yourself is arguably the hardest part and the most important. #tag the perils of speculation and the lure of the crowd. Let's dig a bit deeper into speculation itself, what it is, why it's so tempting and dangerous.
Okay.
As Graham saw it, speculation plays out over really short time frames, months, weeks.
Sometimes even faster, right?
Yeah.
Like day trading.
Exactly. Hours, even minutes. And the source of your potential return isn't really the underlying business. It's extrinsic. It's about who else owns it, how popular it is the price moving up or down right now?
So it's not asking, what's this company actually worth?
No. The speculator asks, what will someone else pay for this? And crucially, how soon can I unload it? It's like a game of hot potato. You just hope you're not holding it when the music stops.
That sounds exhausting.
Yeah.
And stressful, like being on this constant emotional roller coaster.
It is. Graham described this cycle. Starts with doubt, moves to hope, then confidence, then maybe complacency, even greed. Then inevitably the fall into fear and despair, then back to doubt, and the whole crazy ride starts again.
Just a hamster wheel. Trading on hunches, maybe? Flipping stuff just for the thrill until it's not thrilling anymore.
And what's really insidious is how addictive it can become. Graham compared it directly to things like overeating, drinking, drugs.
Wow, that's strong.
It is. But he warned, very bluntly, if you speculate with more than a tiny fraction of your money, you're likely to lose it all. That initial rush of making quick money, it traps you.
Like needing a bigger hit each time.
Exactly like that. You chase bigger gains, especially after losses. You can't stop. You lose sight of any long-term goals. You just keep throwing good money after bad until, poof, it's gone.
And this whole thing is fueled by something you mentioned.
Yeah.
The silence of the losers.
Right, and the free money illusion. Think about it. When people lose big speculating, are they shouting it from the rooftops?
Probably not. Too embarrassed.
Exactly. But the few who get lucky, who hit it big temporarily, they're everywhere. On social media, telling everyone how easy it was, it creates this totally skewed picture. You hear the one success story, not the thousands who went bust trying the same thing.
We saw that big time recently, didn't we? Yeah. 2020, 2021.
Oh, massively. The pandemic hits, governments flood the system with money, interest rates are near zero.
And everyone's stuck at home.
And suddenly the stock market turns into this giant online casino, basically. Brokerage accounts exploded. Robinhood went from like 5 million accounts to 18 million in just 15 months.
18 million, that's huge.
It's insane. Roughly 1 in 25 Americans open a new account then, often first-timers.
And that's when the meme stocks really took off. AMC, GameStop, Bed Bath & Beyond.
Virgin Galactic.
Yeah.
Yeah, the name meme itself is perfect, right? From Richard Dawkins, my mema, something imitated.
Because that's all it was. People just imitating each other.
Pretty much. Everyone else is buying, so I should too. That was the entire investment thesis for many.
And for a little while, it worked.
For a few wild months, yeah. It defied logic. Then, predictably, boom, they crashed, one after another. A few early birds made fortunes, sure, but most people jumped in late, paid way too much, and got crushed.
So why do people keep falling for it? That story about the trader. Made $1.5 million, treating it like a casino.
And then lost it all. Ended up working in a deli for $14 an hour. It's a stark reminder. It proves that universal rule. Whenever making money feels effortless, keeping it is about to get incredibly difficult.
So Graham boiled down this unintelligent speculation into what, 3 main types?
Yeah, 3 key warnings. First, speculating when you think you're investing.
Yeah.
Confusing those two activities, that's dangerous.
Okay.
Second, speculating seriously like it's your job when you just don't have the knowledge or the skill for it. Treating it like a profession when it should be, at most, a tiny pastime.
Right. Don't quit your day job.
Pretty much. And third, maybe the most critical, risking more money speculating than you can actually afford to lose. Money you need for, life.
So tying this all together, what's the takeaway for someone listening?
It means understanding yourself, your own biases, your emotions, how you react under pressure is just as important, maybe more important, than understanding the market itself.
Because, as Graham said, the biggest enemy
is likely to be yourself. #tag battling your inner investor psychology, fluctuations, and inflation. Yeah, Graham's line is so powerful. The investor's chief problem, and even his worst enemy, is likely to be himself. He even riffed on Shakespeare, right? The fault, dear investor, is not in our stars and not in our stocks, but in ourselves.
That hits home. And it feels even more relevant today, maybe, with everyone needing some stark exposure just to keep up.
Yeah.
You're automatically exposed to that temptation, that emotional ride.
Absolutely. The temptation is always there.
It takes real willpower, doesn't it?
Yeah.
To not jump in when everything's rocketing up, or not panic and sell when everyone else is freaking out. That fear of missing out or fear of losing everything, it's strong.
It's incredibly strong. And what's fascinating is how Mr. Market's moods directly mess with our moods, our decisions, often unconsciously.
How so?
Well, psychologists have shown that even subtle emotions change how we perceive risk, what choices we make. Take sadness, for instance, common in a downturn. Sadness can make you want smaller rewards sooner, pay more for things, even make riskier bets seem appealing, and makes it really hard to be patient. It's like poison for long-term thinking.
Okay, wow. And what about stress? Market volatility is definitely stressful.
Big time. Stress messes with your working memory, makes it hard to focus on long-term goals. You might just keep doing the same thing even if it's failing. That's perseveration.
Sticking to a losing strategy.
Yeah. Or jumping to conclusions, ignoring new information. And paradoxically, stress can also make you take more risk, trying to quickly win back what you lost, which is usually the exact wrong move.
Okay, so picture this. Mr. Market is absolutely livid, banging on your door, screaming that your stocks are down 30% since yesterday. You can sell, but you shouldn't just react, right?
Definitely not. You have the obligation to think first.
So maybe step back, go somewhere quiet, and imagine a friend just lost that money and is asking you for advice. What would you tell them?
That's a great mental trick. It forces objectivity.
Right. Ask yourself, okay, prices are down, but what about the businesses I own? Have they fundamentally changed? What about taxes if I sell now? If someone just gave you this stock today, would I immediately return it? Has it dropped this much before? And maybe the biggest one, if I liked it enough to buy it at a higher price, shouldn't I like it more now that it's cheaper? Isn't it effectively on sale?
Those are exactly the right questions to ask to counter the emotion.
Okay, so shifting gears slightly, but related, how does the bigger economic picture, like inflation, play into all this?
Inflation. Yeah, for investors, Graham would say inflation isn't just some random event. It's the background noise. It's the environment you're always operating in.
We kind of forgot about it for a while there, didn't we? That long stretch after '08 with super low inflation.
We did. It was easy to get complacent. But most of us suffer from what psychologists call money illusion.
Money illusion? What's that?
It's this basic misperception. We tend to overreact to high inflation in the short term, but we underreact to low, grinding inflation over the long term. We focus on the nominal number, not the real purchasing power.
Can you give me an example?
Sure. Think of Amelia, Bella, and Charlotte. Each inherits $500K, buys a house, sells it a year later. Amelia buys in '79, sells for $560K. Looks like a 12% gain.
Yeah, that sounds good.
But inflation that year was 13.5%, so she actually lost 1.3% in real buying power.
Ouch, okay.
Bella buys in '01, sells for $520K, a 4% gain. Inflation was only 1.6%, so she had a real gain of 2.4%. She actually came out ahead.
Got it.
Charlotte buys in '21, sells for $530K, a 6% gain, but inflation was 8%, so she also lost real purchasing power, down 2%. 2 out of 3 lost money in real terms, even though the sale price was higher. That's money illusion.
That makes it really clear.
Yeah.
So historically, how bad has inflation been?
We've had some nasty bouts. The worst 5-year stretch was 1915, 1920. Cost of living almost doubled. Compare that to maybe 15% total rise between 65 and 70. Just for context, the last 20 years averaged maybe 2.5% annually. 1965-70 was 4.5% average. 1970 alone was 5.4%. So it varies a lot.
So what does this mean for different assets, like bonds versus stocks?
Well, anything with a fixed dollar payout, like a traditional bond, obviously gets hurt badly. Its buying power just shrinks.
Makes sense.
Stocks offer the possibility, no guarantee, that rising dividends and share prices might offset that loss of purchasing power. They tend to do okay when inflation is moderate, say up to 4% a year.
But if it really spikes, like double digits,
then stocks tend to do terribly. Historically, real losses averaged over 7% a year in those high inflation periods. Think late 70s or after the World Wars.
Okay, so stocks aren't a perfect inflation hedge either. What about housing? People always say buy real estate.
Yeah, that's common advice. But your house is primarily a home, right? Not purely an investment hedge. Robert Shiller at Yale found that from 1890 to 2014, U.S. home prices only grew 0.3% per year after inflation.
Wow, almost nothing in real terms.
Pretty much. Commercial real estate might do a bit better, but it's still only partial protection and sensitive to rising rates.
What about newer things, like Bitcoin? People called it digital gold.
Yeah, that narrative was popular, but its track record as an inflation hedge is, well, unproven, to say the least. It's too new, too volatile.
So how did it actually do when inflation was high recently?
Terribly. In 2022, when inflation was raging, Bitcoin crashed almost 2/3, the opposite of what a hedge should do. Then in 2023, as inflation fell, it soared 156%. It's just not behaving like a reliable hedge.
Okay. Commodities, gold, oil.
Popular idea, but also imperfect. Commodity funds did well in 2022, maybe up 20-30%, but individual commodities are all over the place. Lithium gained over 400% in 2021, then lost 80% in 2023. Wild swings.
So pulling this all together, what's Graham's big takeaway on inflation and assets?
It comes back to diversification. His point in Chapter 2 was crystal clear. Because the future is uncertain, you can't afford to put all your eggs in one basket. Not all bonds, not all stocks.
Because you don't know what environment is coming.
Exactly. Diversification acts like insurance against all those unknowns, high inflation, low inflation, stagflation, whatever comes next.
Okay, we've covered the psychology, the environment.
Yeah.
Let's get practical. Graham laid out 2 main paths for investors, right?
Yes, 2 distinct approaches. The defensive investor, sometimes called passive, and the enterprising investor, who's more aggressive or active.
And picking one isn't about being better or smarter.
Not at all. It's not a confession of weakness to be defensive. It's an honest self-assessment. How much time and effort are you really willing and able to commit?
Okay, so the defensive investor, they're not putting in tons of time researching stocks.
Right. Unwilling or unable to sink that time and effort into building a portfolio piece by piece. But, and this is crucial, they still have to learn how to stick to a plan. Discipline is key for both.
And the enterprising investor.
That's someone who genuinely enjoys the process, studying businesses, digging into financial statements, analyzing things.
And Graham said there's no middle ground. You're one or the other.
Pretty much. He felt that clarity was important for setting your strategy. No half measures.
Okay, let's break down the defensive investors program first. Simplicity and stability seemed key here.
Absolutely. Graham recommended a basic split. Divide your money between high-grade bonds and leading common stocks.
What kind of split? 50-50.
50-50 is the simplest, often the best starting point. But he suggested a range, maybe 25% to 75% in either direction, depending on market conditions or personal circumstances. The main thing is to rebalance periodically.
Rebalance. What does that mean exactly?
It means if stocks shoot up and your 50-50 becomes, say, 60-40, you sell some stocks and buy bonds to get back to 50-50, or vice versa if stocks fall. Maybe do it once or twice a year, or when the allocation drifts by more than 5%.
So it forces you to sell high and buy low automatically.
Exactly. It imposes discipline without requiring constant market timing decisions.
Makes sense. What about the bonds themselves? What kind did he recommend for defensive investors back then?
He focused on safety and predictability. U.S. savings bonds were top of his list, super safe, decent returns for the time, flexible options.
Okay.
Then other U.S. bonds, like treasuries, again, totally safe on principal and interest, though subject to federal tax. And finally, state and municipal bonds, munis. Their big advantage was being tax-free federally and often state-wise, too.
But with munis, you had to watch the quality.
Definitely. Rely on ratings agencies like Moody's or S&P. Stick to the top ratings, AA, A, or A for adequate safety. The core idea for defensive bonds was unquestioned safety, predictable income, maybe some tax benefits. Capital preservation first.
Got it. Now for the stocks, Graham had that specific checklist, right? 7 criteria.
He did. It's quite quantitative, but the idea behind it is what matters. First, adequate company size. Big established firms.
Less likely to disappear overnight.
Right. Second, strong finances. Things like current assets being at least 1.5 times current liabilities, meaning they can easily pay their short-term bills, and limits on debt relative to assets or equity. Basically financially solid.
Okay.
Consistent dividends for at least 20 years. Shows a long history of returning cash to shareholders. Fourth, no losses in the past 10 years. A decade of profitability.
Consistent performers.
Fifth, decent earnings growth, at least a third increase in per-share earnings over the previous 10 years. Some momentum. Sixth, priced not too high compared to assets. Specifically, priced no more than 1.5 times net asset value or book value.
So not paying a huge premium for what the company physically owns.
Exactly. And seventh, price reasonable compared to earnings. Priced no more than 15 times average earnings over the past 3 years. Or he had an alternative calculation combining PE and price-to-book ratios, making sure the product didn't exceed 22.5.
Okay, that last one's a bit technical, but the theme's clear. By quality companies.
Large, stable, profitable, dividend-paying companies.
At a reasonable price. Don't overpay.
That's the essence of his defensive stock approach. Interestingly, he noted public utilities often fit these criteria well back then due to their stability.
So even with this defensive approach, choosing stable stocks, would he say you just buy and hold forever? Or should you still make changes sometimes?
Good question. He actually suggested that even defensive portfolios should be reviewed and potentially changed from time to time, especially if a stock you bought gets way ahead of itself, becomes really expensive.
So if one of your reasonable price stocks suddenly becomes unreasonable.
Exactly. Then it might make sense to sell it, even considering taxes, and replace it with something else that is reasonably priced. Experience suggests it's often better to lock in gains and pay the tax than ride an overpriced stock all the way back down.
That makes sense. Beyond just picking stocks and bonds, what about the tools to implement this defensive strategy? You mentioned index funds earlier.
Yes. Graham was actually one of the very first advocates for the concept of index funds, long before they became mainstream.
Really?
He recognized the power of just buying the whole market, essentially. They cost almost nothing, so you keep nearly all the return. And the kicker, they consistently beat most active managers and individual stock pickers who rack up huge fees and trading costs.
So ETFs, exchange-traded funds, they fit this bill too. They're super cheap now.
They are remarkably cheap, often just a few basis points. But Graham might have warned about the temptation with ETFs you can trade them all day long, which kind of undermines the whole defensive, buy and hold, don't panic mindset.
Right. The ease of trading could be a trap.
It could be. Traditional low-cost index mutual funds work just as well for the defensive investor if the fees are minimal.
Okay. What other tools did he champion?
Dollar cost averaging. Super simple, super powerful. You invest the exact same dollar amount at regular intervals, monthly, quarterly, whatever. It doesn't matter what the market's doing.
How does that help?
Well, when prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares. Over time, you end up with a lower average cost per share than if you tried to time the market. Graham said it will pay off, ultimately, provided that it is adhered to conscientiously and courageously.
Courageously when markets are falling, I guess.
Yeah.
Keep buying.
That's the hard part, but yes.
Then there's rebalancing, which we touched on. Selling winners. Buying losers to stage your target allocation.
Exactly. It's the practical way to buy low, sell high without guesswork.
And maybe the most important tool for staying disciplined, the investment policy statement, or IPS.
Crucial. Absolutely crucial, especially for defensive investors who want to minimize decisions. This is your written plan, your constitution.
You joked about keeping it in a break glass in case of emergency box.
Ha! Yeah, only half joking. The point is, make it hard to change impulsively when you're feeling emotional.
So what goes in an IPS?
Your core philosophy. Your patience strategies, rebalancing rules, dollar cost averaging schedule, your investment selection criteria, focusing on low costs, maybe setting an expense ratio limit like 1%, a commitment to not trade based on emotion or news, maybe even setting a small mad money limit like 5% max in a separate account if you absolutely must scratch that speculative itch. And crucially, how often you'll monitor things maybe just quarterly and always looking at long-term multi-year returns first, not the daily noise.
Got it. A written plan to keep yourself honest and on track.
Exactly. It's your defense against your own worst impulses.
Okay, now let's switch to the enterprising investor. This path requires more work, more knowledge.
Definitely. Graham was clear. The enterprising investor needs considerable knowledge of security values, enough to treat it like running a business. It takes real effort. He also noted wisely that youth can stand these disappointments and profit by them.
Meaning it's okay to make mistakes early on when the stakes are lower. Learn from them.
Precisely. Those early mistakes, while painful, can be invaluable lessons for building skill and resilience.
So how should someone prepare for this path? Graham had specific advice, right? Like paper trading.
Yes. He strongly recommended spending a full year studying and picking stocks without buying any. Use online portfolio trackers. Test your ideas. Train yourself without risking real money first.
Build the muscle before lifting the heavy weights.
Good analogy. And compile watch lists. Lists of companies you've researched, understand, and would love to own if the price becomes attractive. Having that list ready before a market panic helps you act rationally, helps override that instinct to sell low and buy high.
Makes sense. And he also talked about learning from mistakes, memorializing them, like that mistake wall you mentioned.
Yeah, the Davis Advisors example is great. Framing the certificates of stocks that blew up AIG, Lucent. It's about confronting errors, not burying them. Graham implicitly advocated this by stressing analysis. The only way to learn from market feedback, which is often delayed and unclear, is to document your reasoning before you buy.
Like, what's my thesis? What edge do I think I have? What's my target price? What's my time frame? How confident am I?
Exactly. Write it down. Then you can go back later and see where your thinking went right or wrong. It forces honest self-assessment.
Okay, so what kind of strategies did Graham suggest for the enterprising investor? Where should they look for opportunities?
He generally favored focusing on undervalued larger companies. Why larger? Because they usually have the resources, capital, management talent to survive tough times and recover. And the market tends to notice improvements in larger companies more quickly.
So where does the undervaluation come from?
Could be several things. Maybe just currently disappointing results that have made the stock unpopular, or long-term neglect the market just hasn't paid attention. Or sometimes the market fails to see the true earnings power, like that Northern Pacific Railway example he used from the 40s.
And the classic Graham bargain basement strategy, buying below net working capital.
The ultimate cigar butt investment, as Buffett later called it. Finding a stock where the price is less than the company's net current assets minus all liabilities, you're essentially getting the operating business, the buildings, the brand for free or even less than free.
Does that even happen anymore?
It's much rarer now than in Graham's day, especially with larger companies. But he found about 150 examples back in 1957. His Burton-Dixie example was great, bought at $20.64 when net current assets were $30 a share, sold for over $53 3.5 years later. 165% gain. Pure, deep value.
Okay. What about special situations or workouts?
Yeah, he touched on those, things like mergers, acquisitions, liquidations, spin-offs, but he was very clear. This is a highly technical area, really a field for professionals, very complex, lots of risk if you don't know exactly what you're doing. His examples from the early 70s often had tricky, sometimes disappointing outcomes.
So probably not for the average enterprising investor starting out.
Probably not.
Then there's the strategy you mentioned, Charlie Munger's blunt advice.
Huh. Yeah, the sit on your ass, SOYA strategy. Munger's point is that huge opportunities are rare. Most of the time, the best move is to do nothing. Just sit patiently.
But while you're sitting, you're not just idle.
No. You're constantly learning, studying industries, reading annual reports, building that watch list of great companies you'd love to own at the right price. Then, when Mr. Market finally does go crazy and offers you that incredible bargain, maybe years later, you're ready to pounce, and pounce decisively.
Okay, so patience, preparation, then conviction. How do modern tools fit in? Stock screeners.
They can be very helpful for the enterprising investor. Tools like Koifin, FinViz, you can filter for Graham-like criteria: low debt, low PE, low PB, good dividend yield. You can also screen for positive trends like rising cash flow, return on assets, or return on invested capital, ROIC, looking at averages over 3 to 5 years to smooth things out.
Any pitfalls with screeners?
The main one is getting too complex. Simple models often work better. Don't over-engineer it. Less is often more. Find a few key metrics that align with your strategy.
And finding those real super stocks, the massive long-term winners. It's not just tech, right?
Not at all. That's a huge misconception. The top 30 over the last 30 years include things like pool companies, used car dealerships, tobacco, police equipment suppliers. Really diverse.
So what do they have in common? What makes a super stock?
A few things stand out. Management thinks long-term, 5-10 years out, not just next quarter. They have strong moats, durable competitive advantages. They generate lots of growing free cash flow. They're rarely commodity businesses. And they tend to grow by inquisition, finding new ways to make money from what they already do rather than just risky acquisitions. NVR, the home builder, is a good example, performed incredibly well, even through recent volatility.
And you mentioned return on invested capital, ROIC, as a key metric.
Yes, it's a great one. Basically, it measures how effectively a company uses the money invested in it, both equity and debt, to generate profit. Net operating profit after tax divided by invested capital.
What's a typical ROIC?
Average across the U.S. market is historically around 9%. Consistently high or rising ROIC, well above that average, suggests the company is very profitable and its managers are great at allocating capital to good opportunities. It's a strong sign of quality.
So even if you don't consistently beat the market as an enterprising investor, there are other benefits.
Absolutely. Think of it like playing a sport or a challenging game.
Right. You don't quit chess just because you're not Magnus Carlsen, or soccer because you're not Mbappe.
Exactly. Being an enterprising investor can just be plain fun. It improves your skills, connects you with interesting people, it sharpens your analytical thinking, forces you to be independent, helps you practice delayed gratification.
And gives you real insight into what makes a good business tick.
Totally. Those benefits go way beyond just the potential extra financial return. It's a rewarding pursuit in itself.
Yeah.
Hashtag navigating the financial landscape advisors, accounting, and market mania.
Okay, let's talk about getting help. Finding good financial advice. You'd think it'd be easy, but it feels like a minefield. Graham saw this even back then.
He did. He talked about the miscellaneous character of advice sources. And yeah, it hasn't gotten simpler. Maybe just more complex, more ways to get confused or misled.
So what was Graham's core take on relying on advisors?
His thesis was pretty stark. If you're going to rely mostly on others, you either have to stick to super standard conservative stuff, almost unimaginative investments, or you need to know your advisor exceptionally well, have real intimacy and trust.
And if you don't have either of those?
Then you must build up your own knowledge, enough to pass independent judgment on whatever advice you're getting. You simply cannot outsource your critical thinking.
Why is finding truly unbiased advice so hard? Conflicts of interest.
That's a huge part of it, unfortunately. Many in the industry are incentivized to maximize their fees, not necessarily your net returns after those fees.
Like traditional brokers.
Often, yeah. They might hedge their opinions, use that Delphic phrasing, vague language that sounds smart but commits to nothing. Analysts face pressure to be market timers, always with one eye on the ticker, the other on generating commissions or deals for the firm. It's just not set up for pure client-first thinking a lot of the time.
And it gets even trickier with things like IPOs, new offerings.
Graham saw that clearly. The buyer in an IPO is often inexperienced, easily swayed by slick salespeople pushing stories. He lived through periods like the early 60s and late 60s with this flood of low-quality companies being sold at absurdly high prices.
He had examples, right? AAA enterprises, based on the magic word franchising.
Failed within 2 years. Penn Central, the country's biggest railroad, went bankrupt in 1970, shocking everyone. Stock went from $86 to $5.
Wow. And LTV. the company that just bought everything with its own stock.
Ling Temkovat became the 14th biggest U.S. company by just acquiring stuff. Then the whole house of cards collapsed. These weren't small blips. They were major failures hyped by the street.
And today we see similar patterns, maybe different products.
Similar dynamics for sure. High-cost mutual funds, complex annuities with huge commissions, sometimes 10% upfront, plus high annual fees.
Ouch.
And the push towards alternative assets, hedge funds, private equity, venture capital, sold as exclusive, sophisticated.
Like how the big endowments invest, like Yale.
Exactly. But the pitch ignores the reality. To invest like Yale, you must be like Yale. They have incredible expertise, decades-long time horizons, massive scale, ability to withstand losses, tons of cash, advantages individuals just don't have.
Right. And we saw that SPAC frenzy recently, too, special purpose acquisition companies.
Another classic example. Insiders getting huge chunks for pennies, potential conflicts with managers getting paid by the companies they acquire. It's rife with potential issues.
Nikola and Virgin Galactic were prime examples. Trucks rolling downhill, charismatic influencers, then huge crashes.
Textbook cases of hype over substance, fueled by structures that benefited insiders more than public investors. Nikola's founder was convicted. The stock lost 98%. Virgin Galactic soared on hype, then plummeted.
And it's so easy to get confused by titles and credentials, too. Wealth manager sounds official.
But means nothing legally. It's self-appointed. And those top financial planner awards, we saw the story. Maxwell Tailweiger, the Dachshund puppy, got one for $183. It highlights how easily these things can be bought or faked.
So how do you find good advice? What about robo-advisors? Are they a solution?
They can be part of the solution for some. Digital platforms, low fees, usually around 0.25%. They use ETFs, rebalance, offer tax efficiency. That's good.
What's the downside?
Personalized, deep financial planning is often less of a priority. It's more about automated portfolio management. Maybe the future is centaurs, a human planner working with AI tools. Best of both?
Possibly. But for finding a human advisor now, what are the key questions to ask to cut through the noise?
You need to be direct. Ask, will you always act as a fiduciary, putting my interests first, and will you state that in writing? Must be yes.
Okay, what else?
Do you earn more cash, trips, whatever, for recommending certain products over others? Should be no. Do you earn fees advising private funds or other things you might recommend to me? Again, should be no.
And that alignment question.
Right. Who manages your money? Ideally, they say, I do, and I invest in the same things I recommend to clients. Get these answers in writing, maybe via email. Score them. See who's truly aligned with you.
Okay, good practical advice. Now let's shift to another potential pitfall. Accounting tricks. Creative bookkeeping.
Ah, yes, the numbers themselves. Graham warned, the more you rely on those precise per-share earnings figures, the more careful you have to be about how they're calculated.
Like special charges.
Exactly. Companies can bury losses as special or one-time charges that don't hit the main earnings number everyone looks at. LCOA did this back in 1970, making earnings look better than they were.
What else? Depreciation.
Big one. Choosing straight line versus accelerated depreciation can significantly swing reported profits. Train boosted earnings almost 20% just by switching methods. R&D accounting, inventory methods like FIFO versus LIFO, lots of ways to make numbers less comparable.
And then there's this whole world of non-GAAP earnings.
Welcome to non-GAAP land, a magical place where companies tell, well, fairy tales. Expenses disappear, temporary income looks permanent.
Like Groupon inventing ACSOI.
Adjusted consolidated segment operating income, which conveniently excluded huge online marketing costs, turned a big GAAP loss into a supposed earning. The SEC stepped in on that one.
And WeWork's community-adjusted EBITDA.
Right. Waved away sales, marketing, admin costs, turned a massive $933 million loss into a $233 million earning. We know how that story ended. Bankruptcy.
So what's the defense against this for the average investor? Become an accountant.
Probably not practical. Graham's advice was simpler. Focus on getting good value for the price you pay. And crucially, look at average earnings over a long period, 7 to 10 years, ideally.
Why the long average?
It helps smooth out the bumps of the business cycle, and it dilutes the impact of those special charges or credits. Gives you a much more reliable picture of the company's true underlying profitability over time.
Okay, that makes sense. Now let's revisit something we touched on. The madness of crowds. Herd behavior.
It's such a powerful force. Being part of the crowd just feels safer, doesn't it? Especially when things are uncertain or risky, we instinctively defer to the group.
And social media just pours gasoline on that fire.
Absolutely.
Yeah.
When everyone's focused on the same thing simultaneously, like a meme stock, it intensifies everything. Memory, emotion, motivation. We saw those swarms on Reddit, Twitter, Discord, pooling buying power, driving prices up.
AMC, GameStop.
Exactly. Early buyers make huge paper profits, drawing more people in.
And research shows this influence is real. Like seeing peers disagree makes you more likely to switch your choice.
Up to 3 times more likely, even if you're not consciously aware it's happening. Agreeing with the crowd or with experts literally triggers reward centers in your brain. Social media algorithms amplify this by feeding you stuff you already agree with, creating echo chambers. People in echo chambers trade more and earn less, and every like reinforces the behavior, encourages more trading.
So Graham's advice is the antidote, to stand out from the crowd.
You must stand apart from the crowd. It sounds simple, but it's profound.
So for any investor, defensive or enterprising, you need that ability to just tune out the noise. Turn your back on the herd.
You have to, otherwise you're constantly reacting, constantly whipsawed by news and rumors and emotions. Independent thought and self-control are paramount. #, the ultimate protection margin of safety. Which brings us to Graham's absolute core concept. His motto, really. The single idea that ties everything together. Margin of safety.
Margin of safety, okay?
Yeah.
The ultimate protection.
He called it the thread that runs through all the preceding discussion. It's central.
How did it apply originally, like to bonds?
Think about it historically. For a railroad bond to be investment grade back then, the railroad had to earn enough to cover its interest payments not just once, but maybe 5 times over.
5 times.
Wow. That huge excess earning power, that cushion. That was the margin of safety. It protected bondholders if the railroad's earnings dipped later. The beauty of it, Graham said, is that a large margin makes an accurate prediction of the future unnecessary. You just need to be confident things won't fall off a cliff.
Okay, that makes sense for bonds with fixed payments. But how does margin of safety work for common stocks? They don't have fixed payments to cover.
It applies, but differently. A stock could have a margin of safety if, for example, the company was so financially strong and the stock price so low that the entire company was selling for less than the value of bonds that could safely be issued against its assets and earning power.
So you're buying the whole company for less than its secured debt value.
Essentially, yes. Graham saw situations like this in the Depression lows. You got the safety of a bond, plus all the potential upside of owning the stock, higher income, price appreciation. It's the ultimate bargain. Buying dollar bills for 50 cents, but knowing the dollar bill is backed by solid gold.
Got it. And there's a link between margin of safety and diversification.
A very close, logical connection. They work together. Think of it this way. Even with a margin of safety on a single stock, that one stock could still go wrong for unforeseen reasons. The margin only gives you better odds of profit than loss. It doesn't eliminate the possibility of loss.
Okay.
But if you diversify across many investments, each chosen with a margin of safety, it becomes much more certain that your total profits from the winners will outweigh your total losses from the losers.
Like the roulette wheel analogy.
Exactly. If the odds are against you, pay out less than odds, diversification guarantees you lose. But if the odds are slightly in your favor, pay out more than odds, a positive margin of safety, then diversifying across many bets makes winning almost certain over time.
So diversification kind of wraps an overall margin of safety around your whole portfolio, protecting you from any single bad outcome.
Perfectly put. If one 5% position goes to 0, you've only lost 5% overall. But if another 5% position goes up 1,000%, your whole portfolio is up 50%. Diversification limits the damage from mistakes while allowing winners to contribute significantly.
Crucially, though, this margin of safety depends on the price you pay, right?
Absolutely critical. Graham stated it plainly. The margin of safety is always dependent on the price paid. It's large at a low price, small at a higher price, and disappears completely at some still higher price.
The Amazon example really drove this home, buying it in 1999 at the peak.
Selling for 15 times sales, 10 times Walmart's ratio with no earnings. You were right about the company eventually, but the price offered 0 margin of safety.
So you waited 10 years and survived a 94% drop just to break even.
Roughly, yeah. Just to get a modest profit. Painful.
Versus waiting until late 2001 after the crash.
Right. Price had plummeted. Sales had nearly doubled. Losses narrowed. Now it's sold for only 0.74 times sales, less than half Walmart's ratio, even though Amazon was growing faster. The margin of safety was much, much better. Still maybe not positive, but far less negative.
So the general rule is the higher the expectations baked into the price, the more growth is assumed far in the future.
The wider the margin of safety you need. Because even a small disappointment in that expected growth can absolutely hammer the stock price. That example of 25% growth versus 20% growth over 30 years, the end value is drastically different, showing how sensitive prices are to those long-term growth assumptions.
Okay, so how do we build this into our own thinking, especially when we face conflicting data or just our own biases trying to lead us astray?
One practical way is to make forecasting more formal, less gut feel, more structured process. Participating in things like the Good Judgment Open Forecasting Competition or using their training, it can actually help rewire your brain.
Rewire.
By forcing you to consciously override those quick, intuitive, emotional responses with more deliberate, evidence-based thinking. Practicing that structured forecasting helps build the mental muscle for more rational decisions under pressure.
And maybe the ultimate safety net, knowing when to sell.
Selling is the final backstop, yes. It prevents a mistake from wiping you out completely. But of course, the challenge is knowing when to sell without missing out on huge future gains if you were actually right initially. It's a tough balance.
So at the end of the day,
building a margin of safety into every aspect of your investing, the price you pay, the companies you choose, the diversification you maintain, the way you manage your own emotions, that's the best possible insurance against being wrong. And we will be wrong sometimes. The margin of safety protects you when that happens.
So we've really covered a lot of ground here. Journeyed through Graham's timeless wisdom, unpacking the difference between investing and speculating, navigating market psychology, building resilient portfolios.
Whether defensive or enterprising.
Right. Critically looking at advice, understanding accounting tricks, and landing on this central idea, the margin of safety.
It really boils down to understanding value and understanding yourself, not chasing charts or headlines.
It reminds me of that Benjamin Franklin quote you mentioned.
Oh, yeah. Human felicity is produced not so much by great pieces of good fortune that seldom happen, as by little advantages that occur every day. It's about the consistent application of sound principles. Discipline.
So as you're listening to this, maybe reflect on these questions. What do you want investing to be for you? A serious endeavor or just entertainment? Are low costs and instant trading obligations you feel you have to act on constantly? Or options you use rarely? Deliberately?
Good question.
Do you want to chase every hunch? Or follow policies and rules that build mastery over time? Do you want to live in self-delusion? Or use investing to become more honest about yourself, your strengths, your weaknesses?
Do you want to be a maniac trader, swinging between fear and greed? Or find a path to financial serenity, quiet confidence?
Ultimately, do you want your decisions, your emotions held hostage by millions of strangers out there? Do you want Mr. Market dictating your thoughts?
Or do you want to think for yourself? By internalizing these ideas, Graham's ideas, by embracing that margin of safety, you really can build a financial fortress, one that not even Mr. Market, at his most manic or depressed, can knock down.
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button, subscribe for more summaries, and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.